Thanks. Morning, everyone, and thanks so much for the opportunity to chat to you today. As Trevor mentioned, I took a look at the various ASISA categories net flows in and out of over the last few years to try and identify how investors behaved in 2020, to try and see if there were specific behavioral trends during the 2020 market crash. Now, to be able to identify the shorter-term 2020 specific trends, I feel it's important that we first take a look at what the industry's mindset was leading up to 2020. So on this chart, I show you the cumulative net flows of the two major multi-asset categories, being the multi-asset low equity and multi-asset high equity, and we can clearly see a shift in trend over the last 4 years. Both of these categories had more than 10 years of consecutive net inflows, and then halfway through 2016, the low equity category started receiving outflows or experiencing outflows and had more than 50 billion rand worth of outflows over 4.5 years. Similarly, the multi-asset high equity category towards the end of 2018 had a change in trend and has since had 30 billion rand in net outflows. Now, this for me is a very interesting shift in trend, as both of these categories are predominantly Regulation 28 compliant funds, which means they're used in clients' retirement saving products, which makes up a massive part of our savings industry and are long-term in nature. Now, over the same period, the enhanced cash space experienced a massive increase in inflows or an increase in demand. Here I show you the cumulative net flows of the short-term interest-bearing category. Now, this is funds like the Nedgroup Investments Core Income Fund, as well as the multi-asset income category. Now, this is funds like Nedgroup Investments Flexible Income or the Select Income Funder Fund. Now, both of these categories had more than 130 billion rand of net inflows over the last 4.5 years. In other words, they had almost 300 billion rand of net inflows over the same period that the multi-asset equity categories had less than 100 billion rand in outflows. Now, this for me also suggests that not only did clients switch out of multi-asset equity into the cash and income space, but also that new money was invested in income instead of in the multi-asset space. Now, we so often find that there's a very strong correlation between the recent shorter to medium-term performance and then the subsequent flows. And we believe that this change in trend or the shift from multi-asset equity to income and cash has been no different. Here I show you the rolling 3-year returns of the multi-asset low equity and high equity category compared to that of the two income categories I'm referring to. And here you can see how the poor performance from equity markets in 2015, 2016, and again in 2018 and 2019 has impacted performance. And we believe that the underperformance of the multi-asset funds or the deviation from what investors expected from these categories has caused investors to shift out of the multi-asset space and into the income space instead, and also to not yet invest in the multi-asset category. In other words, they chose to rather hold income or cash and wait for growth assets to recover and to show signs of now it's okay to reinvest. Now, I first want to tackle this thought of switching across risk categories a little bit. And for me, I can put it into 3 buckets in terms of the types of investors who are switching. Firstly, we have investors who are in an incorrect risk profile. So they're either sitting in a fund with too much or too little growth assets, and then they choose to move to a different category, being either a lower risk or a higher risk. Then we have a bucket of investors who are currently invested in the perfect profile. They have the right exposure of growth versus income assets given their financial needs, but they choose to either invest or switch to a lower or a higher risk category. And then the third bucket would be natural aging of investment goals and investors rebalancing as they approach the end of their time horizon. Now, the first 2 buckets that I spoke about is usually brought on by short-term performance. It's usually a case of the markets deviating over the short to medium term from what clients expected over the long term, and causing them to switch. So in the first bucket I mentioned, you have investors who maybe got away with having too much risk in their portfolio because equity markets weren't experiencing a downturn, realizing that they have too much risk and switching down and de-risking to increase the capital protection. And then the second bucket that I mentioned, which is the one, as Trevor mentioned in his intro, that we really always urge clients to avoid, is the bucket where even though clients are invested in the appropriate risk profile, short-term performance believes them to think the grass is green on the other side. So they're chasing the recent performance or the current performance rather than staying true to their investment profile, their investment needs, and what they should be investing in. And it's this bucket that can destroy so much value because we usually see clients switch out of the growth assets after the fact, so after it's had poor performance, and then only re-entering once it's recovered a little bit. So it's really a case of selling low and buying high. And the other area of risk over the last 3 years that I want to touch on a little bit is the opportunity cost of not taking on enough risk. So this is now the group of investors who can afford or who should be sitting in low equity or high equity multi-asset, but because of current market conditions or recent performance, chose to rather wait it out in the likes of the income or the multi-asset income category instead. And this risk presents itself in the form of an opportunity cost. So what I show you here is the shortfall or the opportunity cost of an investor who should have been exposed to a multi-asset equity fund, but instead invested in an income fund on the left-hand side or in a multi-asset income fund on the right-hand side of your screen. So just to unpack this a little more, if you look over the 1 year period on the left-hand side, what those two bars show you is, firstly, the light green bar shows you that R1 million that was invested in an income fund a year ago, instead of low equity, has missed out on 57,000 Rand worth of performance, so almost 6%. And over the same period, investing in income, even though you could have afforded the risk of a multi-asset high equity fund, you've lost out on more than 11% of performance. Similar story in the multi-asset income space. Let's look at the 2 year period there, which includes the significant market crash of 2020. Again, a client that invested R1 million 2 years ago in the multi-asset income space that should have, from a risk profile perspective, sat in the multi-asset high equity space, has lost out on 36,000 Rand. Now that's close to 2% per year in terms of performance. So to end off this section in terms of where was the industry at before 2020, I think it's safe to say that clients were quite light on risk already. So if you think of the roller coaster of thoughts that goes through investors' heads when the markets are volatile, I think a lot of clients were already sitting at that, let's just cut my losses and get out. I don't want to play a part in this equity growth game. Okay, so now let's switch to 2020 and go through the trends of the COVID-19 crisis. What did investors do? How did they react? And what have they been doing since? Now, the first trend I want to show you, which is by far the most notable one, is the massive demand for global equity, the global equity general category. On the left-hand side, I show you the cumulative net flows into this category, into the CISA category over time. And there you can very clearly see that massive demand for global equity towards the end of 2020. On the right-hand side, I put it into numbers for you. There you can see that over a 13-month period, ending July 2021, that category has received 36 billion Rand of net inflows in a 13-month period, whilst its previous longest available history of 199 months was only 30 billion Rand of net inflows. So massive demand for global equity from the end of last year, or the second half of last year. And then the first thing that always comes to mind for me when I look at a demand for offshore assets is that question of, was the currency considered, or did it play a part in the investor decision, and how did the currency impact people's behavior or the success of their trading? And the reason the currency is so important is because it's a second layer that you need to consider when it comes to performance when investing offshore. Because remember, when you invest offshore, your rand return is both a result of what the underlying dollar asset is doing, as well as what the exchange rate is doing. And so often we see those two move in opposite directions. You would often have global equities falling, experiencing a market crash, and at the same time, because of that risk-off sentiment, the SA rand weakening because of it being an emerging market, and in rand terms, the weakness of the rand and the loss of the offshore asset kind of net each other off. Now, on this chart, I just give you some insight into how investors traded over the last 18 months. The green bar shows you the net flows in or out of the global equity general category, and the light green line, just what the exchange rate was as at that month end, to give you a sense of where the rate was over that period. Now, there we can see that a lot of investors exited global equities at the bottom of the market in hindsight, after it fell by more than 30% in March. At that time, they were shielded by the weakness in the currency, being more than 20% weaker than the start of the year, and net, they were close to neutral in terms of performance. Then we see a period of global equity demand starting, while the rand was still weak, so an expensive time to buy back in. And the last few months has actually been quite a good period of the rand hovering close to fair value and investors carrying on to buy in. And just out of interest sake, the rand strength over the last 1 year period has detracted by 15% in rand terms on the performance of the global assets. Now, it's impossible to time both of these and to try and play them. So the message here for me would just be that your reason for the demand of global assets and the reason for including offshore assets needs to be clear, needs to fit in with a bigger picture, rather than trying to either time the currency or get away from the South Africa specific issues. And the last part of my presentation is just having a look at how did investors behave through the South African equity volatility. Now, our market has been all over the show the last few years. If you look at the last 7 years, we've had 2 patches where it effectively did nothing for a 2 and 3 year period. We've had a few big ups. We, of course, had the big down in 2020 with the market falling 33%. And since then, we're up 83.5%. So a lot of volatility to deal with for clients. And it's in this type of market environment that we so often see clients switch. Now, remember, equity is a high-risk, long-term asset and really shouldn't be traded in and out of in the short term. But let's have a look at what clients did. Similar to the global exercise, I show you the net flows into the CISA SA equity category on a monthly basis by the bars, combined with what the equity markets did over that period. There was some good trading in April, some clients buying into the weakness after the market had hit rock bottom. But the period that concerns me is that July to October period where investors were disinvesting from equity while the market was weak. So selling low, and then you can clearly see a positive momentum of investors re-entering towards the end of 2020. Now, to just illustrate the cost of switching and the cost of trading in and out of a high-risk volatile asset, I've put together a scenario of 3 investors. All of them at 100,000 Rand at the end of 2019. Investor number 1 remained invested in equity, and that's the top line, today sitting at 124,000 or 24% up from his initial investment. Then on the other extreme case, we have the investor that was also in equity, also 100,000 Rand, panicked at the bottom of the market and exited for cash, never looked back, still sitting in cash, now only has 71,000 Rand, so 29% down from his initial investment. And then somewhere in the middle, we have the client that did what the industry trends suggest, being exiting equity, sitting in cash, and only returning towards the end of last year. And that client is the middle line, still 8% down from his starting investment at 92,000 Rand. Now, the moral of this picture for me is just so clear that it's so important to stick to the plan, irrespective of what's happening in the short term. So to end off, what's the 3 things I would like you to take away from our session today or from the analysis of the industry flows? Firstly, always stay true to a client's risk and return objectives and let their financial need analysis drive how much growth and how much income assets they need to have, and stay true to that plan. The second important thing is, and we hear this so often, is it is about time in the market. Stocks, bonds, currency, cash rates can change so quickly, it's impossible to know when what's going to happen, and it's just so important to just remain invested for the right period of time in your right portfolio. And then lastly, when it comes to growth assets, like your international exposure, it's even more important to be clear on why you're including it, and let that rationale determine your allocation and your time frame, rather than getting swept up in the currency and trying to time other volatilities. Great, thanks so much for your time. That's all I have prepared for today. Trevor, back to you.
Seugnet, thank you so much. Very interesting, as always. To keep on track with the time, unfortunately, I'm not going to ask you questions, or good for you, but rather I'm going to invite you back for another interesting presentation again, because that's, I think, very useful points that you put across there. So
Perfect.
thank you. Thanks for your
Trevor.
time.